Hi, Mark.
Hello. Nice to be here.
I should introduce myself. I'm Scott Sumner, Bentley University.
And I'm Mark. Oh, go ahead.
And you're Mark Thoma of University of Oregon?
Yes, that's me.
So we're going to talk about the whole economic mess, the financial crisis, and the recession today. And I guess we're going to start off by talking about the factors that led to the crisis. And I thought I would start by asking you what you see as the factors that triggered the initial problem in, say, 2007, some of the root causes.
Yeah, so let me just give my standard story about the lead up to this thing, and then I'll turn it back over to you to do a little more criticism on the monetary policy. So this is just my general overview of the way I see it, and then you can correct me any way you think it needs to be corrected. But I don't see any particular source of this crisis myself in terms of one. I've been asking myself, is there one villain I can point to and say, this is what caused the crisis, that's it, that's what we need to fix? And I'm not convinced that there is. And let me give you my reasons why. I think that the first thing you needed was a big source of liquidity to make this thing work. So you needed some big source of money somewhere in the world. And I think there were two factors there that were really important. That was a low interest rate policy pursued by the Fed, and they may have had no choice given that the tech bubble had just happened. But nevertheless, that certainly created a lot of liquidity. And there was also a lot of liquidity coming in from overseas, from the Asian countries and the OPEC countries, from their high savings from oil. So that really created the pool of money that was needed to blow up this bubble. But we needed something else to go wrong. We needed to concentrate this money in certain ways so that risk was concentrated. And it needed to flow into the housing sector and in a way that could allow these prices to blow up. And when I look at these markets, I see problems just about at every step along the way, incentive issues that should have been fixed but weren't. For instance, if you look at just the real estate agents, their incentive is to sell houses for the highest price possible and sell as many as they can because they're working on a 6% commission. Here in Oregon, we have sellers agents, but nevertheless, their incentives aren't really to minimize the price because that costs them money. You look at the brokers, they were getting these loans off their books very quickly for about 6 months. They had some connection to them, then they're repackaged, resold, and that really just takes any long-term connection to those loans off the books. So their incentive was just, they were getting paid pretty much by the mortgage, was just to pass these things through as quickly as they could. The real estate appraisers, their incentives were all wrong. They were trying to please the people they were appraising. We know there were problems with the rating agencies, both in terms of the incentives, in terms of who they were paying, and the mathematics or the risk models they were using. We look at executive pay, and the incentives don't look real good there. I already mentioned the risk models that were flawed. Every place we seem to look along the way in this process, there seems to be something that happened, something went wrong. And, and at first I said, well, that means we can't really point our finger at any one thing. But now I'm starting to wonder if at every step in the process there was something wrong, if maybe there isn't a common cause, in some sense these markets were captured. But that's really another discussion. But in any case, I see all those things, the liquidity coming in from the Fed, from overseas, the money passing by all these markets that had these incentive flaws in them. Markets are supposed to regulate these things and fix these things. So all these markets seem to have problems in them, and that really set the stage for this bubble to blow up and eventually to pop. And now let's turn to what we really want to talk to, which is the Fed policy along the way, and I'll let you tell us a little bit about how you see the Fed's response to this crisis.
Yeah, I mean, first of all, I mostly agree with your analysis of the first part. I mean, I think it was kind of a perfect storm of a lot of bad incentives plus just some bad luck and bad decisions. I mean, there's no getting around that banks made a lot of decisions that were foolish in retrospect, even from their own perspective. But you add on that there were some bad incentives in the system as well, and the monetary policy, I think, was a little too easy in 04 to 06. I mean, my special take on this is only really the second part of the crisis, and I've been working a lot on the period around August to October of 08, when we'd already been in recession for 6 or 8 months, and then suddenly it got a lot worse. And I think a lot of people kind of misdiagnosed the problem, thinking it was just sort of like the same problem, but just more intense than before. And my take is that there was a real qualitative change in the nature of the crisis at that point. It went from being primarily a financial sort of housing problem to being a real nationwide and even worldwide sharp drop in aggregate demand. And the sort of a metric I like to look at is nominal GDP. The whole dollar value of the economy was growing about 3% a year for the first 9 months of the crisis. The last 2 quarters, it's dropping about 6 or 7%. So that's a real dramatic change. And I think what some people may have missed is both the fact that there sort of was a reverse causality that set in. Instead of these financial and housing problems driving the economy lower, this really sharp drop in aggregate demand was actually worsening the financial crisis after about, say, September of 2008. And there's a lot of indicators that showed that the nature of the crisis changed suddenly. It's quickly spread to manufacturing around August. You started to see really big drops in inflation expectations into actual deflation expectations. Of course, the stock market crashed in early October. Commodity prices crashed. Interestingly, the dollar strengthened a lot from July to November. So, and that's the dollar, and also looking at inflation expectations and real interest rates in index bonds. Some of those things pointed to me towards the monetary system, and that maybe monetary policy, although it looked expansionary on the surface with the target rate only at 2% in that period, in reality it was maybe more contractionary than it seemed. And I'll maybe talk a little bit more about that later. And that's sort of my take, that we misdiagnosed. Analogy I would give is that what started out as a cold turned into pneumonia, and the appropriate remedies for pneumonia might be antibiotics that are inappropriate for cold. And a lot of people just assumed we had a much worse cold starting late last year. So I've had a real focus on monetary policy in the last 8 months, and what it didn't do, what it could have done, and maybe even what it should do now. And that's what I've been kind of working on in my blog that I set up a couple months ago.
Yeah,
so that's a little bit of an introduction to my take on it.
And the blog is called Money Illusion. Let me put in a plug for it.
Yeah,
You've been doing
I hope
great.
they give me a plug. And I'm sure your blog is Economist View, right?
Yes.
I'm blanking on the name. Yours is much more well-established and long-lasting and popular, but I'm sure they'll link to both of those.
You've been doing a great job. Let me just add, so you're adding a dimension here that I haven't really focused on, which is to say I think the Fed made perhaps 2 mistakes here. They misdiagnosed initially the problem as a liquidity problem, and they thought it would be contained. So we kept hearing Bernanke and others come out and say, yeah, we can clean this up. It'll be contained to the financial sector. If it pops, it's not a big deal. And so I don't think they were worried about aggregate demand soon enough. They weren't looking forward enough. They didn't diagnose the problem well enough to really see the aggregate demand problems that are going to come. And as you know, with the lags involved in monetary policy, if you don't see these things coming by the time it happens, it's really too late. And I really agree with you that as aggregate demand started going down, that really snowballs or makes the financial problems worse, and they feed on each other, and you get this downward spiral. And
even though, just to interject one point, even though I've been very critical of the Fed, it's a little bit understandable when it first happened in the August to October period, because we just come off the high oil prices. So the backward-looking inflation rate was really high. The lagging 12-month inflation rate was still very high at that point. And so I actually think the first few months of their error are understandable in retrospect. It's more after October, when the deflation expectations set in, that I've argued they should have been more forward-looking. But go ahead.
Yeah, and what I was going to say is that where I was focused more is I think they also misdiagnosed this as purely a liquidity problem when there were actually solvency problems and other problems in the background.
Yeah.
So a lot of their initial responses was to create these facilities that really reopened connections between borrowers and lenders that the crisis had shut down, thinking that if we just get these connections reopened and get the liquidity flowing again, that's going to solve the problem. But the problem was much, much bigger than anyone realized going in, and economists have taken a lot of criticism for that, and perhaps rightly so. But in any case, this thing just turned out to be much bigger, much longer, and much deeper than I think any of us expected going in, and that really led to a lot of bad policy errors along the way.
Yeah, and in a way, you could argue that they made it worse. I mean, I also don't put a lot of weight on liquidity. I mean, it's kind of a vague term anyway. I mean, some people use it for monetary policy and some for other costs of transactions. But I think it was a solvency issue at the beginning. And the other thing, I was just looking at some housing numbers the other day, and the housing crash initially was concentrated in the bubble states, California, Florida, Arizona, Nevada. And starting around this time I mentioned, August, you really started to see housing prices falling pretty sharply in the last 6 or 8 months all across the United States, even in the middle part of the country that had been a little bit protected from the initial subprime crash. So it seems to me that this sharp fall in aggregate demand or nominal GDP it's actually made the debt crisis much worse than it had to be. We had to suffer through a certain amount of pain from a lot of bad decisions were made by banks in terms of subprime and adjustable rate loans and so on. But I think what's happened is the aggregate demand has fallen so sharply that a lot of loans that might have been reasonable loans based on expectations of growing nominal spending turned into bad loans when we had this really sharp contraction last fall. So it wasn't just a question of we misdiagnosed how bad the problem was going to be, but we actually made some policy mistakes that also made the debt crisis worse than it had to be, although I would never deny that we had to suffer through a certain amount of pain from all these mistakes in the subprime lending area. And I'm not suggesting we should have tried to inflate to cure that bubble by any means, although some people misinterpret that on my blog. But go ahead.
Yeah, I don't have a lot to add to that. I'm pretty much in agreement. So just to be sure, why don't you tell us how you would have responded differently if you were the Fed? I believe you would have been much more aggressive in lowering interest rates right away and perhaps less aggressive on opening new facilities. Is that a fair way to characterize your position?
Yeah. Let me just start with a framework that Lars Svensson at Princeton has advocated, that the Fed sort of target the forecast. That is, try to set policy so that their forecast of where the economy is going is also their target. So if they wanted nominal GDP to grow 5% or inflation to be 2%, they should set the policy instrument like the Fed funds rate at a level where they actually forecast that to occur over the relevant period, say 12 months. And I think that mostly they do that pretty closely. But I noticed in October all of the forecasts were falling way, way below any plausible target you might have, even though they are a little bit vague about it. And it was clear to me that they should have really been much more aggressive at that time. And this might be a bit of a stretch, but I think the real dramatic stock market crash that was in the first 10 days of October might have been a growing realization that all the policy attention was focused on the Paulson Bernanke bailout proposals, and they were sort of letting monetary policy slide, and aggregate demand was falling sharply. So I would have had them be very aggressive. It could have been immediately reducing interest rates to zero, doing quantitative easing, which they've recently adopted. Another thing that I think was a mistake is they started paying interest on reserves, which normally might be a reasonable program, but in a deflationary scenario, it can encourage banks to hoard reserves and not move the money out into the economy. So I opposed that policy, as did some other well-known economists like I think Robert Hall and James Hamilton. And in addition, I would even go further and argue there should be a penalty rate on excess reserves if it continues to be a problem of banks hoarding or holding on to too many reserves. So I think the penalty rate on excess reserves is maybe one of the more novel ideas in my blog. Just being more aggressive in general, though, in around October of last year.
Would you go so far as to, some people have actually proposed changing required reserves so that they fall in the bad times to encourage lending. Would you go in that direction at all? Probably it doesn't matter because they have so many excess reserves anyway. But,
I mean, right now it wouldn't help much, and even I'm not even sure about quantitative easing unless they can solve the excess reserve problem. And it's an interesting problem because we're in an area where we don't have a lot of experience, and we're working with situations where our models are not particularly applicable. So I know Mankiw's blog talked about a negative interest rate on all forms of the monetary base, that is cash plus bank reserves. But it was sort of just an idea one of his students came up with, and it's hard to really implement for cash. So I've never really proposed that. But if we did that for bank reserves, had a penalty rate, it would essentially break the liquidity trap problem, which is the equality between the rate of return on reserves and other assets like Treasury bills. You could sort of lower the rate of return on reserves lower than T-bills. It would not solve the problem of hoarding of cash by the public, but so far the main problem of hoarding has actually been in the banking system, excess reserves. So I'm really surprised the Fed hasn't done more in terms of looking at that option, and I still don't know why they're paying interest on reserves. Even at 0.25%, which is low, it's higher than banks can earn on Treasury bills, which is the closest alternative asset. So, yeah, I mean, you could get rid of reserve requirements, but as you say, probably now they'd actually have to do more than that because of all the excess reserves. And again, I'm really puzzled that the profession hasn't talked more about these options, and it isn't sort of being discussed. Maybe the Fed is considering it, and I don't know about it, but I haven't really heard any good arguments against being more aggressive in trying to force banks to reduce their excess reserve holdings, which would have the same effect as quantitative easing.
The only thing I would say on the paying on reserves, I'm not disagreeing with you. When you hit a zero interest rate, this isn't a point that matters, but above zero interest rate, the one thing you can do with a corridor system is sort of separate the monetary aggregate from the interest rate. So what happens is you push, you know what I'm saying, you push out into the flat part of the corridor, and then you set your target at that lower bound.
That's right.
Technical for the audience.
It gives you
can separate the two tools. Exactly. But when you hit zero, you lose that dual control anyway because you can't go below zero.
Yeah,
so I'm not sure there's any advantage to having an interest rate penalty. That is an advantage in the normal times. Once you hit a zero interest rate, I'm not sure there's any advantage there anyway. And
well,
so
there's a very interesting quote by Robert Hull and Susan Woodward on their website. They talked about the Fed's explanation for their interest on reserves policy. And last fall, the interest rate was a little higher. And at that point, they wanted to have an interest payment on reserves so that as they did this massive injection of liquidity in the banking system, they could still control their target rate, as you say, and not have it just quickly fall to zero. And their term was that this was a, quote, confession, unquote, of contractionary intent, or something to that effect. And it's interesting. It is true that if you want to keep control over both the quantity of reserves and the rate, you'd have to do something like this, but that begs the question of last October, November, December, what would be so bad about interest rates falling to zero? And that's why I find the Fed's explanation puzzling for that policy.
That's what I was trying to say, too. Once you hit zero, so, yeah.
Yeah,
exactly.
I mean, what's the point? You know, and then once it gets to zero, it's sort of like a non-issue, and that's why I've, I guess, more recently been pushing the penalty rate, which is like essentially pushing it below zero. And, you know, I think theoretically it would. You could even do it in a way that wouldn't hurt bank profits. That's one of the objections that was raised. You could have a positive interest rate on required reserves and a negative one on excess reserves, and kind of balance it out so that you're controlling hoarding at the margin, and yet not hurting bank profits necessarily.
You're really subsidizing insurance anyway, and it's not like they have a big bill for their insurance anyway. They get it pretty cheap as it is, so I don't think we need to subsidize their insurance any further. It probably distorts things more than we'd like.
That's right.
Let me follow up. So tell us, because you and I differ on the need, I think, for fiscal policy, and I believe it comes down to a difference in our confidence in quantitative easing. And so a minute ago, I was interested. You seemed pretty uncertain about the QE, and so why don't you tell us sort of how it works and how confident you are that it will work and all those sorts of things. Then maybe we can move into fiscal policy a little bit as an alternative.
Yeah, I mean, if I could just back up, I'm confident that a country under fiat money can sort of get the job done of getting out of a liquidity trap if it puts its mind to it. I don't think the Bank of Japan ever really tried very hard. When FDR tried in the Depression, he used devaluing the dollar. Now, I wouldn't use that tool today, but my point is there's a lot of different tools, and I think if they did quantitative easing plus a penalty on excess reserves plus a explicit target where they committed that if they fell short one year, they would try to catch up the next year, like if it's 2% inflation target and you only get 1, you shoot for 3 the next year. I think if you did a sort of a package of things together, the effect on the markets would be very strong. That But you're right, just quantitative easing alone, if they're still paying a quarter point interest on excess reserves, I don't have a high degree of confidence that that would work. So that's one thing.
Now, let me, just for people out there, just the way this works mainly is through an inflation effect, and so you make goods in the future more expensive, and so that causes people to buy a car now rather than next year.
Yeah, I think basically, and this is where I agree with some of the new Keynesians like Woodford, monetary policy works very much by changing people's expectation, and that includes the whole future path of monetary policy. So you need credible policies that you are going to persistently pursue a certain like inflation target. And if you can generate confidence in the public that you'll do that, you can lower real interest rates even when nominal ones are stuck at zero. So if you generate expectations of inflation, that will lower the real cost of borrowing, and it'll push up asset prices. And by that I mean things like housing, commodities, stocks, all sorts of things like that. Those will respond quickly to monetary policy. Other things respond with more of a lag, obviously. So, but I think the key is to get credible policies, and that's why I think they really need to do something that's a complete package that shows their determination, setting targets, promising to catch up to them if they fall short, and doing various things like the penalty rate on excess reserves to show that they're looking at all dimensions of the problem and aren't just grudgingly, doing one step at a time, which is what the Bank of Japan did.
I've been wondering, if there's not a strong placebo effect here. So the key is just doing something and looking authoritative, and not looking like you don't know what you're doing, which has been a little bit of a problem with some of these policies of the way they've been put in place. I think the Fed could do a better communication job with a lot of these new facilities and in telling us how they're supposed to work and what the point is and all that sort of thing. So I think their communication on some of these moves could have been better as well, but I'm not sure that would have made a major difference.
A lot of people, I think, who are a little bit too defeatist on monetary policy look at the Japanese case. And it is true Japan's had like 14 years of just about continuous deflation and about 1% a year on average. But, they've let their currency appreciate a lot in the foreign exchange market. And as Lars Svensson said, almost a foolproof way out of a liquidity trap is if you depreciate your currency.
Yeah.
So, it's clear that the Bank of Japan has really never been very determined to create a little bit of inflation in Japan. And they twice raised interest rates when they still had about a 0 to -1% inflation rate. So I think people are too pessimistic, partly because they misread the Japanese case. But I really think something very ambitious by the Fed would have a dramatic effect. And obviously only time would tell if they pursue it.
Yeah, those counterfactuals are. And you're not alone in that. People like Brad DeLong have been making this same claim for a long time, that the Fed needs to move more aggressively, and that could make a big difference, and fiscal policy wouldn't be so necessary. I guess where I come down on this is I want the Fed to be creative. I want them to put the whole portfolio of policies in. I want them to do everything they can, and I think they should. And certainly traditional policies coming to the end of its rope with interest rates at zero. So all these non-traditional policies and these new facilities and all these sorts of things are certainly necessary. But we have no history of an economy like this, or very little history. We have little history of running these alternative policies. And I just have a huge variance on my expectation about how well these policies will work. And because of that, and because of my tendency to do too much rather than too little, I'm more likely, I think, to want fiscal policy as a backup, with the idea that we can pull back on monetary policy pretty quickly, and even on fiscal policy if we need to. And so I view policy as a portfolio, which I think kind of is what you're telling us too, is that what we need is a portfolio of policies, because we're not exactly sure which one's going to work for sure. But if we do all these different things, perhaps collectively they'll work. And if we find the one that's doing best, we can reinforce that. But I guess where I'm at is that part of that portfolio really does need to be fiscal policy. And within fiscal policy, I'm very much in favor of government spending over tax cuts as a stimulus to aggregate demand. And the reason is that I think households and banks have big holes in their balance sheets. We've seen the big losses in housing, we've seen the big losses in the stock market, retirement accounts, and all that sort of thing. So if we give tax cuts to households, they're probably going to save them. more than they're going to spend them, particularly if these aren't well-targeted tax cuts. Now, I think that asset rebuilding on the household side is something that hasn't gotten enough press and has been too much ignored. If that's something we really need to do, that's a precondition to getting aggregate demand kick-started again on the consumption side, is consumers are going to have to spend some time saving more until they get their balance sheets back into solvency and they're comfortable with them. Then they'll go out and start spending more money. So these tax cuts are valuable in the sense of moving the end of this thing forward, moving the point in the future when we have these balance sheets rebuilt forward in time, and that can do nothing but help us. But in terms of stimulating aggregate demand right now, I am not as much in favor of tax cuts as other. And so I see spending as a much better way to back up monetary policy in case it doesn't work, in case the Fed's reluctant to do all these other things, and simply as a means of dealing with some of our longer-term problems. But let me stop there and let you ask some questions about the multipliers and things, because I want to make some points about Keynesian models, too. And so maybe let me...
Yeah, well, maybe we should start with, if you could give me some idea, not necessarily a number, but even how you approach the multiplier concept and maybe differences between the spending and the tax on the multiplier. So do you want to talk about that, or do you want me to talk?
Let me just say a few brief words. I think we're in a situation where we don't have a lot of estimates, and so we need to turn to theory. This is a situation where our econometrics and our past data aren't going to be very informative, and so what are we left with? We're left with theory, and theoretically, rather as opposed to evidence, I believe that for the reasons I just stated, that the savings rate will be much higher on anything that comes through on the tax side, and hence the consumption side will be less, and that savings won't quickly flow into new investments, so we're not going to stimulate aggregate demand much on that side either. Let me make some other points.
I actually agree on I think the tax cuts would be probably mostly saved.
And on the numbers, the new Keynesian model, so there was a paper, I think, that I saw the other day that said, boy, I ran a simulation with the new Keynesian model, and the multipliers were very, very low. They were less than 1, and that's a big problem. And we get these different effects. And if you calibrate these new Keynesian models correctly, you're going to get small multipliers. You could calibrate them another way, get larger multipliers. I think that you have to be honest about your calibration. But my big problem there is I want to know, is this model really capturing the fundamental transmission mechanism that's at work in this crisis? Is it really the fact that we have sticky relative prices that's the fundamental mechanism that's driving this downturn? And I'm just not convinced that the fundamental mechanism we ought to be worried about is price stickiness of the Calvo variety. I'm very, very comfortable with that model during normal times. It explains sort of normal fluctuations, if you know what I mean. But I think this extreme, this shock, this systemic shock, is driven by something else, and the transmission mechanism is very much different from the one that's built, the rigid price mechanism built into the Keynesian model. For that reason,
can I ask you a question?
I don't find that very informative. Go right ahead.
I'm just to kind of help me understand that point better. Sometimes I get complaints when I talk about targeting nominal GDP at 5% growth, something like that, which is in the long run 3% real growth and 2% inflation.
Right.
People say, well, now the real economy is so screwed up we'd get 8% inflation and -3 real. And I'm just wondering, when you say sticky prices aren't the problem, do you think if we could somehow, either through fiscal or monetary policy, get nominal spending growing at 5 instead of falling at 6 or 7%, would that get the job done, or do you see some sort of structural thing where it's not about nominal spending, you have to target specific sectors like investment, government?
I'm an aggregate demand guy like you. I'm probably more on terms of the real side. And I'm not convinced that what drove this was a misallocation of resources from the fixed prices of the type that Calvo talks about. Now, housing prices are very, very sticky on the downward side, so maybe there is something to the model in that sense. But I don't think the Keynesian model has the breakdown in the bubble that happened in the financial sector built into it. And because that sector and that sort of credit channel transmission mechanism bubble thing isn't in there, I'm not sure that these multiplier estimates really tell us what we need to know from these simulations. And that's really the point I'm making. It's just another way of saying that the models we're using are really inadequate to I think the model's very adequate for analyzing the mid-'80s, the mid-'90s, all those sorts of things, but it's probably not so good for analyzing the present situation. So I tend to discount these multipliers that come out of these simulations and all those sorts of things. It's probably not telling me a lot about the current crisis. And then that's really the only point I wanted to make.
Let me throw out something and get your reaction to it. I think you could argue that what we teach our undergraduates in principles of macro is really a model of fiscal policy that's sort of built for this situation in a way. And here's my reasoning.
Yeah,
in the last couple of decades, there's been a lot of focus on monetary policy as being the dominant stabilization tool, and this idea of targeting inflation and so on and being forward-looking. And if you have like a period of normal times when we're not in a liquidity trap, and the Fed is trying to keep inflation on target or whatever aggregate they're looking at, then if fiscal policy does something for some reason that's going to move inflation away from that, the Fed would sort of have an offsetting move in monetary policy to keep their inflation on target.
Yes.
So in a sense, it'd be like fiscal policy would have almost a zero multiplier, not because it's not working, but because the Fed is offsetting it. But then when you go into this situation of a liquidity trap, where at least the perception is that monetary policy doesn't work, then it kind of revives interest in the whole multiplier process, because now the assumption in the multiplier, which is holding everything else constant, like holding monetary policy constant, actually seems to make sense.
No,
do you know what I mean?
No, I agree
so that
completely.
The revival of the multiplier is associated with the liquidity trap, in my mind.
And there's also some crowding out effects and other sorts of things that affect that multiplier in deep recessions that are built into that model that you don't really see in the new Keynesian version. So, yeah, that old-style Keynesian model really does seem to come back into play. And I felt bad for a lot of years teaching my undergraduates this model, but I'm not feeling so bad today that maybe those tools are at least, giving them some guidance that they wouldn't have had otherwise. You feel like you're teaching an old-fashioned model, but suddenly everything old is new again. And whether that's good or bad is we'll see. I think that...
Yeah,
go ahead.
I don't really have a lot to add on fiscal policy. I mean, you're right. I think, to me, the optimal is monetary policy. So in a sense, if I feel we can, boost aggregate demand with monetary policy, then we can do it with less debt and deficit spending. Within fiscal policy, I think you're right that government spending has a larger expansionary effect than sort of demand-side tax cuts, which is really the type we're talking about in the recent package. Supply side, I do tend to favor normally, but it's just not a politically viable factor now, so I haven't really spent any time talking about it on my blog, so I've been focusing on monetary policy. But with fiscal policy, my only reservation there is that we're probably looking at a fairly long and deep recession, and if we run up very large deficits, there is a substantial sort of cost of distortionary taxes in the future to pay for these, especially as we get into baby boomers retiring and so on, and perhaps national health care. So I think there still are some sort of trade-offs. I mean, I know depression economics, you're not supposed to think of opportunity costs and trade-offs, but I think there still are some long-run ones that we have to sort of take into account in deciding how much to do on the fiscal side.
Yeah, the question I've been avoiding, I've dealt with it a little bit, is we just haven't been very good at doing the other side of Keynesian policy, which is paying for it in the good times.
Yeah.
And the point I made when I talked about subbugs, I want fiscal policy to be available in the future when we need it for exactly the reasons you just talked about. Sometimes monetary policy may not be there. If we aren't willing to, during the good times, pay for what we borrow during the bad times, then in the future people are going to say fiscal policy just isn't an effective tool. It creates deficits. When the time comes, the political economy isn't there to make it work, and we just end up with larger government, bigger deficits, and so on and so on. And so I'd really like to see them do this right on the other side. The other thing that I think is important here, and when you talk about Japan sort of bankrupting itself and fiscal policy going on and on and on, creating bigger and bigger deficits, I think the key there is that if you don't fix the financial sector soon, you end up trying to string the economy along with fiscal policy, and that just isn't going to work. At some point, the private sector has to take over. Consumption has to kick in, net exports has to kick in, investment has to kick in, something has to take over for government spending. And if that doesn't happen, then you're going to end up with this massive deficit problem in the future. So the key to one of the keys, not the only key, but one of the big keys to this deficit problem going forward is that we get this financial sector fixed so the economy can run again. Because fiscal policy alone isn't going to do it. And non-traditional monetary policy alone may not do it either. This may be where the pulse and non-toxic stuff we're going to talk about later comes into play more. But in any case, I just wanted to make that point. Hey, let's move on, since we're talking about non-traditional policy. You've sort of made a name for yourself talking about some different targeting regimes. So we've come into an inflation targeting regime, and now you've talked a lot, you and a few others have talked about nominal income targeting. I'm familiar with that through Jensen's paper, was it 202 or 203? And I think McCallum's done quite a bit on this. But why don't you tell us why you like it better than inflation targeting? And I've got some questions for you on this as well as we go through here.
Well, there's some sort of practical and theoretical arguments. I guess the theoretical argument is it handles supply shocks a little more, it's more accommodative. So if there's an oil shock and you're strictly targeting inflation, you have to sort of lower non-oil prices to keep inflation on target so you could have a recession. With a nominal GDP target, the nominal GDP growth is the sum of inflation and real growth. So if the supply side is not doing well, maybe real growth drops from 3 to 2 or 1%, but inflation creeps up a little, and then vice versa during a economic boom like the late 90s, or even maybe around 2006, you have actually lower than normal inflation because you have more rapid real growth. And that kind of leads into the practical argument that if you look at a lot of times when people sort of retrospectively feel policy was too easy or too tight, often the nominal GDP target looks better. So nominal GDP has averaged about 5% in recent decades growth, but it's been faster during some of the booms like the tech bubble and the housing bubble around 04 to 06. So it would have called for a little tighter money during those periods, and then now when it's falling sharply, I think it's giving a brighter flashing red light of money being way too tight than inflation. I sometimes think there's a disconnect when I hear people talking about inflation. Like they'll say, well, you know, inflation's dropped, it may be down to 0% this year. That's a little bit below the Fed's target, as if it's almost good news. And but if you look at nominal GDP and see it falling at 6 or 7% annual rate the last couple of quarters, it really is a red flag that aggregate demand is way below where it should be. I think it's more revealing in many cases than the inflation numbers, which are distorted by supply shocks and things like that. So a little bit of theory, a little bit of sort of pragmatic arguments, and I mean there's other arguments as well. The other wrinkle I've talked about is having the government create a futures market in nominal GDP and subsidizing it to at least get a better read of where the economy is going, because we're sort of having to infer by looking at the stock market, commodities, interest rates, spreads, all these things, and guess what they're telling us about market expectations. But having that kind of market could be very valuable in terms of directing monetary policy. So that's another area I've done some research in, futures markets and aggregates. And I think Robert Shiller's called for nominal GDP futures markets as well for different reasons. But yeah, I've also argued that the interest rate can be a misleading indicator. You know, when the rate was 2% for a lot of last year, people talk about the Vixelian rate, which is the rate you need to keep the economy stable. And that's sort of an invisible rate you don't directly observe, but that was probably falling a lot in the late summer and fall. So even though the Fed had rates at 2%, you know, in practice, monetary policy was arguably getting tighter relative to what was needed for macroeconomic stability. And that's why I like a lot of these forward-looking indicators, because they give us at least some idea of whether we're headed in the wrong direction.
Let me back up a little bit here then. So if I understand this correctly then, when we have a shock, where it doesn't put the Fed in a dilemma, like an aggregate demand shock. So when they respond to an aggregate demand shock, they're curing both inflation and unemployment at the same time in the right way. Inflation target tends to work fairly well. But when we have aggregate supply shocks, then this nominal GDP targeting tends to work much better. So does the choice between the two depend upon the percentage of the two types of shocks that existed in the past? Is this a way of saying that you believe supply shocks are the dominant factor behind cycles?
Not really. I mean, I think they are a factor, but I don't really think, even in sort of a worst case where it's all demand shocks, there's some other issues involved too. Like, I think sticky wages are more important than sticky prices, and I think I'm probably in a minority there, but I think you can make some arguments for nominal GDP targeting there if sticky wages are the actual problem. Because when you get a boom, what happens is wage rates increases will accelerate, and then in a recession they will decelerate if you're doing inflation targeting. Because what will happen with inflation targeting, during a boom, nominal GDP will grow faster. And since the population's pretty stable, that means per capita nominal GDP is growing faster too. So that's upward pressure on wages. And when wages go through these cycles up and down, if wages are sticky, that can create unemployment. So everybody thinks in terms of stickiness on the price side, prices being sticky. But if wages are sticky, you could argue that input prices like wages are just as valid a thing to try to think about and stabilize. And nominal GDP targeting might indirectly do that better than inflation targeting. So even with demand shocks, I think there are some arguments for nominal GDP.
And Svenson's made the argument that what you really need to do is target an index that highlights sticky prices, whether they be asset prices, wages, output prices, or whatever. And
who made that argument?
Svensson, Lars.
Oh, Sven. Oh,
and
yeah.
I believe it was him, and it might have been Woodford actually. I'd have to go back and look. But the idea is that when you do inflation targeting, what you should target is an index that puts a lot of weight on whatever the sticky prices are in your economy, because those are the prices that tend to get out of line in relative prices. And so you want to stabilize the prices, and then you let your flexible prices adjust to sort of keep your relative prices in line. So you target the sticky ones, and then let the relative prices find the right level. And so this sounds, in some ways, like that proposal. Let me ask another question on this nominal GDP targeting. Are there any information problems? I know nominal, we can observe interest rates daily. Nominal GDP comes out with a big information lag. It's months old by the time we get it. Is that a problem for this approach?
Well, I think that it's a question of sort of ends and means to an end. If you both inflation and nominal GDP have some lag problems, but I think what you have to do, ideally you'd have a nominal GDP futures market. If you don't, you create a model that puts in a lot of variables that are correlated with future nominal GDP growth, and basically try to set policies such that your internal forecast at the Fed is that nominal GDP will grow at your target. And Svensson's also talked about that idea. So, and I think you'd look at a wide variety of things, including asset prices and anything that's forward-looking. But, it's not ideal. It really would be nice to have, this relates to, like, Robin Hanson, who's, I think, been on Blogging Heads several times, has talked a lot about the value of prediction markets as a tool in policy making in general, to give policymakers an idea of the expected outcome of their policies in a wide range of areas. But this is just one of those where it would be really invaluable to have that kind of information. But if you don't, you really have to sort of construct a model to forecast that and then try to essentially target the forecast. And there are problems with it, but I always like to talk about it in the alternative way. Why would you set policy at a level where you expected policy to fail? Like, let's say you wanted 2% inflation, and you set your policy instrument at a level where your own forecasters say we're likely to get 1% or 3% inflation. To me, that makes no sense. So even though there are problems, informational problems in doing it, I still think it's the least bad choice among our options. Does that make
No, it
sense?
does. And forecasting 6 months ahead, you have the same problem with a traditional Taylor rule as well, because you have to forecast inflation and output in the future. And it's,
by the way, I think the 2 months from October to August to October last year are a real problem for like a backward-looking Taylor rule. Things changed so fast that I think the Fed had to move much more aggressively than they would have under a backward-looking Taylor rule. His point about 2004, 5, and 6 may have been correct, but I think there are times you need to be forward-looking. So Taylor was very critical about Fed policy being too expansionary in the housing boom period, and he's written some papers on that.
He tends to blame the Fed more than I do. I tend to put them in with the savings glut, but he tends to blame the Fed more.
I'm with you on the early part of the crisis. I think they were just one of many factors, and I think he overdoes it a little. I blame them a lot for the last 6 months because I think they haven't been aggressive enough. But I think also it's not just that they didn't sort of do enough to offset the crisis, but if you view the Fed policy as like steering an ocean liner towards the goal, and you view the financial crisis as wind pushing the ship in one direction towards the rocks, it's really their job to steer it towards the proper growth in inflation or nominal GDP. And so, in a sense, I do view it as a monetary policy failure. It wasn't just that they didn't sort of rescue the economy, but they didn't do their job that they were supposed to do, which was steer the economy, so to speak, in nominal terms. Of course, they can't, in real terms, control everything.
Let me ask one more question about nominal income targeting. When I advocate inflation targeting, one criticism I get is people say, oh, well, what that means is that whenever wages go up, that means the Fed has to tighten. And so what this is really an indirect way of keeping real wages low. Now, I don't think that's necessarily true. I don't think that criticism really holds water. But what are the differences? You mentioned wages as a difference. What are the differences between the two mechanisms in terms of the way they treat wages?
Well, let me just say this about wages, because I think there's a lot of misunderstanding. I think Greenspan once said something about being concerned if wages grew at a faster rate. Mm-hmm. And of course, if you're a progressive, that sounds really bad, like you're just trying to hurt the workers or, stabilize the financial system on the back of the workers. But the point here is the distinction between nominal and real wages. I mean, monetary policy probably doesn't have any long-run effect on real wages. So if you have a policy that keeps wage growth fairly stable at, 3 or 4, say 4% a year, then workers will earn their real wage increase through inflation being lower than their nominal increase if we have productivity growth in the economy. Of course, you need productivity growth. And also, of course, if you don't have a redistribution of income towards capital, which is their other complaint in recent years. But the Fed probably is not a cause of that redistribution. But I don't think that it's really a pro or anti-worker policy to be trying to have stable growth in nominal incomes because the real income is going to be determined on a completely separate plane of productivity factors and the supply side of the economy. So I think that answers part of your question.
In the long run, it's not going to be any different. In the short run, there may be some advantages.
Yeah. Short run, it might. But, I think you have to set up these systems for long run. And right now, what I'm talking about would help them in the short run because I think they need much more rapid nominal income growth. So my policy in the short run would definitely help labor as a class. So, that would be my way of looking at that question, I guess.
Well, go ahead.
Do you want to switch over to a little bit like the Geithner plan and stuff? Because I think we want to talk about that.
One thing that we really need to do, boy, I'm worried. My frame on the picture on my computer froze, but I'm also doing this on tape, so gosh, let's hope. Let's hope we're okay.
Okay.
I'm sure we are. I've got a tape backup. Okay, the Geithner plan. Let's hope it works better than my technical setup here, but I'm worried that it won't. And so fiscal policy, monetary policy, any of it, if we don't get the banking sector fixed, the financial sector fixed, I think we're in for a long, difficult road. And so the question is, does the Geithner plan help? Is it going to do what we want it to do? Is there a better plan? Is it harmful? All those sorts of things. And so the way I've talked about this is my sort of toxic car analogy, and I'll just run through that quickly to sort of give people what I think is the idea behind the Geithner plan, and then maybe give sort of a very, very lukewarm endorsement of it. I don't know if it's going to work or not. But here's what I have asked people to do, is to think about a bank's balance sheet like a car lot, and it has all these assets on it, but the assets are cars. And on this car lot, half the cars, say, you can have different proportions, but say half the cars, right after you buy them, they're going to blow up, and they're just going to be totaled. There's no scrap value. That's not important. We could have scrap value, but just make it easy. There's no scrap value. They're just gone. They just blow up completely. And no matter how many mechanics you bring in, no matter how much you look at them, they've been sliced and diced, and there's such a lack of transparency that you can't really lift up the hood. They're these modern cars that you can't figure out what they're made of under the hood. It's just too complicated to figure out. There's no way in advance to know which kind of car that you're getting. And so what's happened is people just aren't willing. Say the cars cost $20,000. People aren't willing to risk $20,000 to buy a car that might blow up. If they get a good one, sure, it's worth that much, but a bad one's worth zero. So what you should see in this market is prices of those cars beginning to fall. And the expected value is $10,000, but if people are risk averse, the price is actually going to fall a little bit below that $10,000. Say they're selling for $7,000 is what people would be willing to pay for those cars. But the firm has costs of $9,000. If they don't sell them for $9,000, they're losing money and losing more than just to close their doors. And so the market's broken. There's no connection between the buyers and sellers. The sellers want a price that's too high. The buyers won't pay it. Supply and demand aren't intersecting. The market's broken. This is essential business for the town. If it's not working, employment's going to just crash. And so the government wants to step in and try to fix this market somehow. And the question is, what should they do? And I really think that if we think of it in terms of the Fed response, or the Treasury's response, there's really three options that they can think of. One is they could just come in and just buy up all the cars on the lot at some price, maybe $9,000, that makes at least gives them what they paid for the cars and doesn't cost them any money. But that's a hard price to determine, and that's part of the problem is what price do you pay without overpaying. But the government could take those cars in. It could stress test them, drive them a little bit. The ones that are going to blow up. Then they've got say there's 10,000 cars in the lot, they've got 5,000 good cars. They could then go sell those 5,000 cars to the public at maybe $20,000, $18,000. And they could even make money on that deal if the price goes up enough. It really depends. Overall, there's losses. So, and that's really what the original Paulson plan was. To just go in, buy these assets up off the books, and let the bad ones go bad, put those in the junk pile, then sell the good ones back to the public, and hopefully the price has gone up enough so that you either make money or haven't lost too much. The other extreme to that is just to come in, fire the management, say you blew it, go away, we don't need you anymore. The government takes over. They just buy the dealership out all. They nationalize it in essence for temporarily anyway. Then they do exactly the same thing, but they've just taken over the bank. They then take some of the cars, they do the stress test, separate them, and they sell it back to the public, and they get it off their hands. And it's really the same sort of mechanism under the Paulson plan, except they own the whole business rather than the cars themselves. And there's a little more certainty in the outcome. Now, what the Geithner plan does is something in between the two. It's a public-private partnership. So what they're going to do is give people loans to buy these cars. And so maybe someone's only willing to pay $4,000 for a car that the dealership wants $9,000 for. So what the government's going to come in and do is give them a loan for that other $5,000, and that'll let them buy the car. Now, why would someone take out that loan? Well, the government's going to give them a pretty dang good deal. What they're going to say is, if after you buy that car for $9,000, the price goes up to $18,000, then you and I will just share in the profits, and you're going to get most of the profits. But if that price goes down below $9,000 after you buy it, or doesn't go up, then we'll just call it even. You don't have to pay us back that loan at all. That's this non-recourse loan type. And so they're giving people these really, really cheap non-recourse loans as a way to try to get this market restarted.
And that's really what the Geithner plan is. And I have some real doubts about whether they're going to stimulate enough buying through these loans. And if they do stimulate enough buying, they get enough private sector participation in the toxic asset market, whether they're actually going to drive the prices up. And if either one of those things don't happen, they don't get enough participation, or if prices don't go up for these assets, this whole program is going to fail. And it also is not clear to me that it does enough for the recapitalization that these banks need. So I think there's a chance that the price increase could happen, that we'll get a lot of participation, and the price increase will in fact recapitalize these banks. But I'm not at all confident this will happen. And if it doesn't, my view is let's give it a shot, but let's not stick with it too long. If it doesn't work, let's close her down, and let's move on to the next step, which is probably nationalization, and just do something else. Let's not stick with a failed program. That's where I see it.
Is part of the idea behind your approach that the government doesn't have to be as risk averse as private investors?
Yes.
So they can sort of take a broader view?
Yes.
Yeah. Okay. They have deep pockets.
They have deep pockets, so they can come in and take these things. Yeah, and their risk profile is completely different. That's exactly right. And they can also aggregate all this risk into one place. And so what happens when you have these individual purchases is that each person either they get a whole car that's perfect or a car that's bad. By bringing them all together, the government essentially has half good cars to work with, and so you get some risk out. You know what I'm saying?
Yeah. To be honest, I don't know enough about this to have an intelligent opinion on the whole bailout nationalization.
We're getting out of time anyway.
But I'll throw out something from left field here for listeners to think about. There's kind of an interesting sort of an insider trader element to this whole picture. During the Great Depression, they had some sort of bailout programs, and I don't know much about them, but I remember hearing recently that some of these actually ended up costing almost nothing to rescue, mortgages or mortgage banks or something like that. And what happened is, FDR sharply devalued the dollar and got prices rising really fast. There was like 20% rise in the wholesale price index in 1933. And one of the things that's kind of interesting about this picture is that if the government, and here I'm coming back and being a monetary crank again, my favorite topic, but if the government really takes an aggressive approach, investing a lot of money in these assets, arguably, if I'm right about aggressive quantitative easing, they could somewhat influence the outcome of how well these investments turn out, and also maybe with fiscal policy too, if you want to look at it that way, because they actually have some control over the trend of aggregate demand in the economy. And I think, and again, I think this is really underrated. The first half of the crisis was a lot of bad loans, and the second half is a lot of otherwise decent loans being hurt by rapidly falling GDP, nominal GDP. So, it's an interesting puzzle. And another little quirk that pops up is some people like Paul Krugman have been worried about, quantitative easing where the government might lose money because if they succeed in producing inflation and interest rates rise a lot, the government will eventually have to sell those bonds back to keep inflation from overshooting. And that would be perhaps selling them at a loss if inflation caused interest rates to be higher. But that would be a case where the government actually had inside information but traded on it and lost money by essentially buying the wrong kind of assets.
That's right.
Now that's slightly off topic, but this is very much a set of issues where the future course of the economic aggregates will very much affect how these assets are priced 2-3 years out in the future. I'm convinced anyway.
And I'll just note that in terms of your QE, that when we devalue by changing the quantity of gold, that's just a lot like the QE that you've been talking about. It really has the same impact.
Well, the dollar fell, I think it was the biggest one-day drop in quite a while in the foreign exchange market against the euro. It went, maybe it was 2 days, it went from like 130 to 136, right around the announcement of that quantitative easing. So, the markets paid attention, certainly.
And I should add that David Altig at the Atlanta Fed has been cautioning that the Fed isn't really aggressively gotten into quantitative easing yet. So I suspect that if they really move in this direction strongly rather than sterilizing these purchases, that they could have a much more dramatic effect on those exchange rates.
Yeah, it's really unclear what they're doing. The monetary base, which is the money the Fed prints and puts into the economy, cash and bank reserves, it just exploded in the fourth quarter. And normally that would have been very inflationary, but it was hoarded by banks as excess reserves. And after January, the monetary base actually fell a couple $100 billion. And so when I was looking at it, it almost seemed like the Fed was just passively accommodating whatever banks wanted to hold in reserves. And so I'm really waiting a few more weeks to see what happens if, the whole point of monetary expansion from a classical or monetarist perspective is not so much interest rates, but you force more money out into the economy than people want to hold, and they try to get rid of their excess cash balances, and that drives up aggregate demand. So it'll be really interesting to see if the Fed tries to do that, because central banks definitely don't normally try to do that sort of thing in a modern system. They're used to, playing around with interest rates, and it's a very unfamiliar thing for a central bank to do. And but it'll be very interesting to watch over the next few weeks and months what they do with quantitative easing.
Yeah.
To me, it's not a foregone conclusion at all.
No, and just so everyone out there, the way I see what they've been doing so far is more in the terms of risk management. So they've been sort of trading less risky for more risky assets and taking the risk on their balance sheet and really putting less risky assets out there. So they've been sterilizing a lot of these moves. But if they stop sterilizing it, that's going to make a bigger difference in terms of the exchange rates and all of the other inflation.
And, I think people might look back on that, like we look back on, Operation Twist of the 60s and stuff, as not really effective in retrospect. I know James Hamilton in his blog has been critical of, all these. I think he views them as sort of gimmicks, and he thinks, like I do, that the Fed should have just gone for straightforward, more expansionary monetary policy.
Yeah.
But I don't know how you feel about all these accounts they've set up and special facilities and so on. But it certainly, if it's done good, it hasn't done anywhere near enough good, because since they've been doing that in October, things have gotten just dramatically worse. So
it's just gotten so complicated that it's almost like you just wonder, gee, maybe we should have just focused on a couple of things and gotten those right instead of having 10, 20, 30 different facilities. I don't think it's that many, but it has been a complicated, hard-to-follow procedure, and you just wonder if it hasn't been overly complicated along the way, if that hasn't caused as much confusion as it's helped in the markets.
Yeah. Sometimes people tell me my ideas for quantitative easing and, zero interest rates and penalty on reserves, that these are like risky new strategies. I say, well, compared to what we're doing now, what's the difference? Let's try risky ones that might work, actually. So...
well, I don't have a lot left to talk about today.
Yeah.
I think we're
probably about done.
Yeah. Go right ahead.
No, I don't really have much else either.
I've enjoyed this. We were going to talk about the future a little bit, and neither one of us had much to say. I think we both agree that something needs to change so that we don't have this happen again. We may differ a little bit, but I see that we're going to need some sort of regulation, increased capital requirements, and other sorts of things going forward. But the exact form of that regulation, I don't think we know what it's going to look like for sure yet. But anyway, it seems clear to me that we need to bring the shadow banking system under the same umbrella that the traditional banking system's under. And that alone, just having a consistent set of rules for all these institutions, could probably go a long ways towards sort of getting more stability into these markets. But unless you have a lot, let me give you a few words on that, but I don't have much more to say about that than that.
Yeah, I don't have any specifics. I guess people that know more about it than me, I think should think about why it is that our system is so fragile today. In the 1920s, when we had no deposit insurance, banks were more conservatively managed, and I think deposit insurance is an inevitable part of the modern world, but that plus too big to fail and some other things has made banks live closer to the edge, feeling sort of protected. I think as a result, rather than reacting to past crises like trying to prevent another subprime fiasco, which the banks are not likely to do again in the exact same way,
until we forget,
we should think deeper about the systemic problems. Like how I'd like to think regulators approach the topic would be, think about how conservatively banks would be managed if they didn't have all these protections like deposit insurance and too big to fail, and then try to set up regulations that sort of force them to be as conservative as they were in the 20s, where it wasn't until deep in the Depression that most banks really got into trouble. And this time around, it was like a slight wind, and it knocked down the whole banking system. Whereas it took a hurricane-force wind in the 30s, and even then, many of the banks survived that. So it's kind of ironic that we had, in some ways, a more fragile system because there was no deposit insurance, but also a more conservatively managed system back then. So it would be looking for ways to replicate that degree of conservativeness in their approach to leverage and things like that.
Without giving away the safety, if we can, which is a tough.
Because I think that's not realistic. Whatever I think about that, it's a part of the modern world, as Iceland recently found out. Because I think the British told them to pay up on their banks that were branches over in other countries. So.
Well, I've enjoyed this a lot. I appreciate
it's been
this.
fun.
It's been nice.